All right, let's get right into it. Today we're talking about Nordson Corporation. Now, for decades, this company has pretty much been the poster child for a high-quality industrial investment. But right now, this champion is facing a pretty serious test, and it's putting that premium reputation on the line.
So, to really get why Nordson is such a big deal, you have to understand this term Dividend Aristocrat. Think of it as an exclusive club. It's for companies in the S&P 500 that have not just paid, but increased their dividend for at least 25 years in a row. It's a huge badge of honor, a sign of incredible financial strength and consistency.
And Nordson? Well, they don't just meet that standard. They absolutely shatter it. We're talking 62 consecutive years of increasing dividend payouts. I mean, think about that. That record goes through multiple recessions, market crashes, you name it. It is the absolute definition of a long-term compounding machine. So you hear that and you're probably thinking, okay, what's the problem? If this company has such an incredible history of performance and reliability, why are we even having a debate about the stock? What exactly is putting this champion on trial? Well, that's what we're going to break down. Okay, first up, let's look at the bull case. All the reasons why long-term investors have absolutely loved this company. At its core, Nordson is what you'd call a durable compounding machine, and it really all starts with their brilliant business model. The company runs on that classic razor/razor blade model. So they sell these mission-critical dispensing systems, that's the razor, which become a core part of their customers' manufacturing lines. But here's the magic. They then get this steady, predictable stream of revenue from selling the proprietary parts and consumables, the blades, that are needed to keep those systems up and running. And check this out. This chart just shows you the power of that model. A full 57% of Nordson's revenue last year came from these recurring sales. Now, if you're an investor, this is huge. It means more than half their business isn't tied to the wild swings of big capital spending. It's tied to their customers' day-to-day production, which gives them this fantastic cushion, especially when the economy gets a little rocky. All right, the second pillar of the bull case is Nordson's just incredible profitability. You know, it's one thing to sell a lot of stuff, but it's a whole other game to turn those sales into huge profits. And frankly, Nordson is one of the best in the business at doing exactly that. And this number really puts it all into perspective. Nordson hit a 32% EBITDA margin last year. For a company like this, that is an absolutely elite top-tier number. It just screams that they have a technological edge, real pricing power, and high switching costs that basically lock their customers in. So, to wrap up the bull case, you've got this super durable business model with tons of recurring revenue, elite profitability, crazy strong cash flow, and now a smart strategic move into the more stable medical device market. It's a really compelling long-term story. But, and there's always a but, right? You can't just ignore what's happening right now. And right now, Nordson is in a tough spot. So let's flip the coin and look at the bear case, which is all about the cyclical squeeze the company's feeling. This one number really says it all. In its latest quarterly report, Nordson's organic sales fell by 9%. For a company that's built its reputation on stability and growth, a drop that sharp, well, it's a major red flag for the market. So what in the world is going on? Well, it's not just one thing. It's a broader cyclical downturn. The whole global industrial economy has hit the brakes, and a couple of Nordson's key markets, we're talking electronics and semiconductors, have been hit especially hard. So this isn't just a Nordson problem, it's a major industry headwind. And then there's this. On top of the slowdown, Nordson just made a massive, nearly $1.2 billion acquisition of a medical company called Atrion. Now, strategically, it makes a ton of sense. They're moving into less cyclical markets. But financially, it was an all-cash deal paid for with debt. That adds leverage and the very real risk that folding in a business this big might not go as smoothly as they hope. So here's where we are. It's a classic standoff. On one side, you have the undeniable long-term quality of this Dividend Aristocrat with its fantastic business model and elite margins. And on the other side, you've got very real near-term pain. Sales are shrinking, the market is tough, and there's higher risk from a big acquisition. This is the central conflict every investor has to grapple with. So if you're an investor, how do you even begin to navigate this? That brings us to the investor's playbook. These are the key signals you need to be watching that will tell you whether the bulls or the bears are winning this fight. First, and this is the big one, you have to watch for organic growth to turn positive again, especially in their core industrial and tech businesses. Second, keep a really close eye on that Atrion integration. Are they actually delivering on the synergies they promised? And third, track how quickly they're paying down the debt from that deal. Those three things are going to tell the story. You know, the source material we analyzed really sums it up perfectly with this quote. This is not a stock for someone who's looking for a quick win. It's for an investor who believes in the long-term quality of the business and has the stomach to ride out these inevitable and sometimes pretty painful economic cycles. And that leaves us with the ultimate question. Looking at everything, is this a rare chance to buy a fantastic long-term compounding machine while it's on sale going through a rough patch? Or is this downturn a sign that the premium price the market has always been willing to pay for this company is about to face a very serious reality check? The answer to that is going to depend on those key factors we just laid out.